Dear class, today let us discuss bank reconciliations. A bank reconciliation means we are going to correct the two accounts which is supposed to be the similar. One account is called the bank account, and the other account is a bank statement. Remember, the bank account is kept by the organization, but again, the bank statement are coming from the bank. So a bank reconciliation try to compare the company record, which is a cash, and the bank statement. So we make a comparison between a cash book, that is a bank column, with a record from the bank. And this bank reconciliation should at least be completed frequently. Yeah, completed frequently, even monthly basis. So why we make a comparison between a bank record and a cash book, that is a bank column? There must be the difference between a bank and the cash book balances. There must be the difference. In most cases, the difference is due to time lag between maybe writing a check and the payment. The one who is supposed to be paid and bring that check to the bank. So in this case, there is some delay. Umeandika check leo, it might took someone 2 days, 3 days to present that check for payment. So that time lag may cause this difference. And that is what is known as unpresented checks. Or the time lag between depositing amount into the bank account and this appearing in the bank statement. Sometimes you may deposit certain amount, but it took some few hours, it took some days for that amount to be credited in your bank account. So this time lag, it might make a difference between the record in the company against the record by the bank. So again, we have a direct debit. Sometimes you may instruct your banker to pay on your behalf, maybe a rent, maybe a salary to employee. So this direct debit in your account may be done without your knowledge that the banker has already effected those transactions. So we have those direct debit, and sometimes there is a standing order, and those order that you gave the bank to pay some services on your behalf. But again, there is a bank charge that may be deducted from your bank account without your prior knowledge. And again, some error or omission in the cash book. So these are the error or omission in the cash book or bank statement. So this error might result to the difference between a record maintained by bank, that's the bank statement, against the cash book. So in these differences, we might have unpresented checks that the company has issued, but they are not yet being presented for payment. So this we call them unpresented checks. Again, we have uncredited check. These are deposited check but remain not credited in the bank statement. Deposit check, but it took maybe 2 days, 3 days for those check to be reflected in your bank statement. Deposit in transit, the company record receive cash and then send to the bank. The cash still is in transit as a month end, then the bank will not record until the following month. So we are again, there must be the source of difference is interest and deposit cash. Depending on the nature of the account, the bank may credit interest to the account. The company is not aware of this amount until they have a bank statement. And we have a bank charge fee. Banker may deduct some amount as a banking fee, and that this is not reflected in they may not instantly reflected in the cash book, and then they may cause the difference. Or check printing charge, so they are like bank charge, or there might be a bank error, or company made some error. So all these are the reasons why the difference between bank account or cash book, bank account, and bank statements. So let us use one example to illustrate this. For instance, if we have a very simple scenario, we have a cash book, a bank column only that reflects the amount which we have in the bank. So on June 1, we had a balance of 80. And if you look if you look on a banking statement also, they have reflect the 80,000. But again, we have a transaction that appear on cash book. This transaction, we have paid some checks to Garan and the Button. And this, for Garan, the amount is seen. But again, for Button, the amount is not reflected in the bank statement. Again, if you look on a debit side, we have amount deposit for Jonas. And this amount have been reflected in the bank statement. So if you went for this bank statement, you found out that we have 145,000. Again, this in a cash book will reflect you 105. So there is a difference. The difference, yes, because in a cash book we have 105,000. In a bank statement it shows 145. So because we have a small transaction, that is very easy to see that there is unpresented checks that is written to Button is not yet presented for payment. So this can be shown. We have a two method. In a bank reconciliation statement is a statement, as we say, it starts either with the balance as a bank statement or with the balance as per cash book. So if we start with the balance as per cash book, which is 105, we have to add unpresented check so that we can have a balance as per bank statement, which is 145. Again, if we choose to start with the bank reconciliation statement as balance as per bank statement, we have to deduct unpresented check, that Button, to get a balance as per cash book. Remember that a cash book is an asset in the business. But again, the documents that are coming from a bank, they try to show shown on a credit side. The bank statement usually are shown on a credit side. Why credit side? Because to them, those who deposited their money there, they are creditor. So let us Use example number 2, where we have a cash book and a bank statement. In our cash book, we have a balance brought down for 100,000, similar to a bank statement for 100,000. But on a debit side, we have deposited the J. Porter and M. Johnson. And if you look for on credit, it is only Porter, but Johnson is not there. The amount of Johnson 220 is not appearing on the bank statement. Together, when you look for on the credit side, we have J. Jacobo and Awad. J. Jacobo 105, Awad 15. J. Jacobo is seen 105, but Awadi is not seen. But again, if you look on a bank statement, on a credit side, we have a bank charge of 20. That 20 is not reflected on the cash book. But again, we have a direct deposit from Giro Credit, 70. That again is not reflected on a debit side. So in this case, we may adjust the cash book before we make a bank reconciliation, or we may make a bank reconciliation before making an adjustment. So let us use both sides, both examples. For instance, if we want to start with a bank reconciliation without making an adjustment, so we have to take a balance in hand as per cash book, 760. We add and presented check, award 15, and the bank gross 70. So this makes us 85. If you add the two 560 with 85, you get 645. And again, we less bank charge. Bank charge 20,000 and credited check is 20. So this gives us a 240. That's balance as per bank statement is 405. This is number 1. Again, number 2, you may start with the balance as per bank statement. So if we start with the balance as per bank statement, the item added above are to be deducted, and those deducted have been added. So balance as per bank statement 405,000. We have to add bank charge 20,000 and then a credited check 220. Get 240. But again, we have to deduct and presented check awarded 15 and those direct deposit 85, so that we can get a balance as per cash book 560. So that is what can be done when there is no adjustment of cash book. But if we make an adjustment to cash book, it means we are going to adjust the cash book with an item that appear on the bank statement. So if you refer the bank statement, you found out that there were two items. Cash book, there were two items on bank statement. One was zero credit, the direct deposit there, so we reflected that on a cash book. So we took a balance, wrote down 560,000. We add the zero credit 70,000. We deduct the bank charge 20,000. Then we remain with the balance scale down 610,000. So you find out that we have adjusted cash book. So if we have adjusted cash book, so the balance that we proceed with is this adjusted cash book. So if we are making a bank reconciliation as at 31st December 2011, so we start with the balance as adjusted cash book. So we forgot 560, now we'll go with the Sita na Kumi. Then we add and presented check 15 to get the balance, then we less and credit the check Johnson 220. Then balance as per bank statement is 405. Then if we started with the balances as per bank statement, which is 405, now we have to add uncredited check M. Johnson 220, and then we less and presented check Awadi 15, so to get balance as per adjusted cash. Tumeelewana? So thank you very much.